massive inflows continue, taking Bitcoin to new highs and knocking on the door of 110K as crypto investors get an early Christmas present. With a huge options expiry coming at the end of this pivotal year and a ton of in-the-money calls still needing to be rolled, we are likely to see January vol and call skew well supported, as next year also promises to be a cracker. All this and more in this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everyone. I'm Imran Larker from Options Insight. I've got my man Dave here from FRNT. And because this is the last episode before the end of the year, we thought we'd all put our Christmas jumpers on. So Happy New Year, Merry Christmas and Happy New Year. Dave, you have completely outdone me on this one.
I can't believe you didn't get a Bitcoin themed.
Well, I didn't even know that there were Bitcoin Christmas jumpers. I mean, that is amazing.
And perfect for me, right? Ho, hodl. Bitcoin.
That is amazing.
Perfect.
Can you believe we've been doing this for a year?
I know.
Amazing. I want to thank everyone who's been watching and supporting us. You've made it possible that we've been doing this for a year, and we're going to keep trying to bring you this great content every week.
Keep liking and subscribing.
Keep liking and subscribing. And actually, on that note, if you like and subscribe and you put hashtag DeribitGiveaway, we've got another giveaway for you this week. And we were racking our brains as to what we could give away. We've done enough hoodies, so we thought, in honor of me thinking about taking up paddle, we're going to give you a paddle racket, a Deribit Padel Racket. So stick your name and your hashtag Deribit giveaway in there, and someone will randomly be selected to win that.
Perfect for the new year, right? When everyone's trying to get fit and healthy again. New Year's resolutions.
Yeah. I'm the same. It's so cliche, isn't it? No, but I definitely just start taking up a sport. So I'm going to have a little go at paddle as everyone keeps raving about it.
Yeah. Awesome. I've actually got a Deribit Padel Racket because I went to a competition they held earlier in the year, which was amazing. So it's definitely it's a good gift.
Up and coming sport. Yeah. All right, guys. Well, let's get back to crypto markets. So 107K. My bet is looking disgusting right now, as 110's like just sort of a standard deviation away. But yeah, what's going on? Anything changed?
Nothing's changed. I mean, one thing I've got to say, and I've been saying this really ever since the election, the price action is phenomenal, right? It is. When you have these big moves and then we kind of get minimal pullbacks and we kind of stabilize, chop for a bit, it just looks really good. And so nothing's changed. The inflows continue to be huge.
What do we see? Like 3 billion last week? Like 45 billion on the year.
It's
staggering.
It's staggering.
Yeah.
It's staggering. It's huge. It speaks to all the things we've spoken about before in terms of like the cash that's been on the sidelines wanting to come into this. It is a paradigm shift in the political dynamic in the US. And that's allowing money to come into this space. And I don't at the moment see what changes that. I actually feel, which I know we've kind of disagreed around, like obviously, we're coming into year end, there are P&L considerations, position management, into year end, but I kind of feel we're going to have the Fed tomorrow. We kind of know what's going to happen there, right? They're going to cut 25.
They're going to 96% nailed on for a 25 bip cut, right?
They're going to signal like a slower pace of cuts going forward. I imagine they kind of point towards like quarterly cuts. I think that'll be wrong because I think we're still living off this sugar high from pre-election spending and all that sort of stuff. If we look at the inflation numbers from last week, under the hood, they're actually, a lot of it's still being driven by like shelter, which you'd expect will come out of it. Core services inflation is actually kind of softening quite a bit. So I still think they'll probably cut more than what the market's price, what the Fed are going to say, but that's probably a story for another day. And it doesn't change the fact that we're still in a very easy environment. Just go last week, right? You had the S&B surprise with a 50 basis point cut. You had the Bank of Canada cut 50 bips. You had the ECB cut 25, but kind of go more explicitly dovish. So we're in this rate cutting cycle. Liquidity is picking up. So I don't see any change. China for me is probably the most interesting thing right now. 10-year Chinese yields are now like sub 175%. I think there's some real stuff brewing there. I mean, we've discussed it a lot. Obviously, last week they come out and said they're sort of flipping on the like to a moderately loose monetary policy and a more proactive fiscal.
Yeah, but that knee-jerk higher in assets was faded fast, right?
It was, and then everyone gets disappointed around like the lack of actual detail around it. Mm-hmm. But when I see like 10-year yields trade at 175, we're pricing a pretty bad scenario, I'd say, and certainly a very sort of soft growth outlook. And yeah, look, they're in a deflationary spiral, and I don't think there's any doubt about that. Where I disagree with some like the macro doomers is because this is the Japanification of China. This is perhaps China's 2008 moment. But where I push back on some of like the doomers around this stuff is that they will do what the US did, what we did here, what everyone done. They will reflate the assets that are the collateral underpinning the debt in the system so that they can go again. Mm-hmm. And I think you'd be silly to bet against them being able to reflate that. But again, I wouldn't touch like Chinese equities. I'd just be long Bitcoin, like, because they're gonna have a debt jubilee by putting rates to zero and getting rates to zero, and they're gonna default by a stealth debasement of the currency. And it's quite interesting to me. You know, I've been saying for a while, like whenever the currency starts to sort of push higher, we like and kind of 730 seems to have been like a bit of a line in the sand. I've always felt that's weighed on Bitcoin because often you've got these intervention flows where they're selling their dollar FX reserves to defend the currency. That in itself is liquidity tightening, and then also I think they're kind of incentivized to sit on Bitcoin and discourage the capital outflows. I think the fact that they're indicating that they're prepared to let the currency go and they're not defending it, perhaps, I think capital is going to flood out of China, and it possibly already is. And it's interesting now the price action that you see in Bitcoin during the Asia sessions, where it's looking very, very bid. Right. So I think the situation in China is getting more desperate. China will have enough to, they've got a huge amount in reserve, and they can fire a lot of liquidity into this market. And I just think it's going to be a beneficiary of Bitcoin. So I kind of think that's going to be a really key driver going into 2025. It's almost making me, I had this kind of roadmap in my head that we'd have a really good Q1, partly because which we've spoken about, we hit the debt ceiling in the US. They're going to have to draw down on that cash that's held at the Fed, the TGA, which is like 750 billion liquidity injection into Q1. And then like Q2 becomes a little bit more tricky from a liquidity point of view because of they then rebuild that, assuming the debt ceiling gets lifted. China maybe pushes all that further back. So we could have a much longer bull run than what I was thinking. I mean, we'll see. We'll have to see how that develops like throughout Q1 of next year. But I kind of think that what's going on in China right now could give us. I know I'm bullish, and it doesn't take lots of experience to be bullish, but yeah, it could create for some pretty crazy moves in Bitcoin and across, particularly obviously the alts, which are very kind of liquidity sensitive.
We've had 2 years of like 100, 150 or 100+% return, right, in Bitcoin. So, we are due another up year before we get the down year in 26. That's kind of the pattern that we've seen quite a long. Yeah. But I mean, it's. I'd be surprised if we don't get a bit more volatility to the downside right next year. Like, I'm not saying we don't go higher. I just think that there is scope for some chop now. Right?
Yeah, and like I think we deal, particularly from a trading point of view and investment point of view, you deal with probabilities, right? And I think for now you still have to go with like the 4-year cycle as being the most probable outcome. But I would say the risks to that being different this time are higher. I think China adds to that, just given where they are in their cycle right now. And then obviously what's going on in the US. And if Bitcoin does become a reserve asset, then I think we all maybe have to rethink that 4-year cycle in Bitcoin. For now, like, you kind of keep it as your base case, but I think the risks are growing that actually we have something that looks very different. Yeah, and I think it's going to be a very interesting 2025, and certainly Q1.
I mean, looking at the options market this week, it's interesting because you're hitting new highs, but you're not getting that kind of speculative bid coming for like short dated upside calls. If anything, all of the upside calls are easing back a little bit, right? So I think people are kind of feeling like this move is a bit exhausted, right?
Yeah.
And whilst they want to still have exposure, so they're like taking off December calls, rolling into January call spreads. There's a lot of call spreads going up in Ethereum in February and March as well. There's still a load more to roll, actually. I was looking, like, next week's expiry on Deribit is enormous. It's like 50% of the open interest is going away.
Yeah.
So that amounts to $20 billion of notional. 15 billion on Bitcoin, 5 billion on ETH is disappearing, right? And looking at where the strikes are, there's a load in the money calls that makes up the bulk of it on Bitcoin. So what are people going to do? They're just going to let those calls expire and do nothing with them? Of course they're not. They're going to roll them, right? So we've already seen a load of rolling. Right. We're probably going to see a ton more getting rolled over the next week and a half, right? And then Ethereum's a bit more balanced. Like, you've had some in the money calls, you've got a load of at the monies at 4,000, and you've got a load of upsides as well. So it's a bit more balanced, and people have bought a lot of call spreads in March because they weren't necessarily as bulled up on Ethereum for December. They're thinking the Ethereum move comes a bit later. So I'm not sure you'll get as much rolling going on in ETH because I think people have already done their stuff for ETH. But yeah, Bitcoin definitely looks like there's room for it to get rolled.
Yeah, interesting. Do I see as well on some of that, like 120K for year ends, like the sort of biggest option strike?
I think it's quite even, like from 100 all the way, up to like 150. I think there's not. Ethereum's definitely 4,000. That's a big strike for December, right? Yeah. But I caught up with Andrew Scott from QCP. Fantastic interview with him this week. A bit of an extended one, but I mean, the guy's awesome. And I was asking him, what do you think about the gamma positioning in crypto options? Yeah. Like, we know in S&P that the option volumes are enormous, and you have like $10+ billion of gamma that dealers have, and it kind of makes the market really sticky. Right now is a great example, right? The S&P cannot get away from 60.55. It is a monster strike for the end of the year, and the market just can't get away from it, right? Yeah. I said to him, do you think the volumes in crypto options are big enough to have that impact? And if not now, does it become like that? And he's like, yeah, right now they're nowhere near to big enough. So, which you've been saying, right? Which I've been saying all year, right? Yeah. And so he confirmed that, but it's good to hear it from him, seeing as he's in the weeds there at QCP. But he does think we are headed that way. But it's just the question of, how long is it going to take for these option volumes to explode, right? But I think with IBIT coming in and with Deribit growing the way it's grown, I mean, notionals on Deribit this year have been unbelievable, right? So, yeah. In fact, now's probably a good time to go over to his interview. Andrew Scott, CCO at QCP. Check out what he had to say, but it was a really fun conversation. All right, guys, this is the last podcast of 2024, and we have got a very special guest today, Andrew Scott, Chief Commercial Officer at the one and only QCP. Great to have you on, mate.
Thank you, mate. Privileged to be invited here today. I can honestly say that of all the podcasts about crypto derivatives set in London, this is definitely top 20. Top 10. No, kidding. Obviously, you guys are doing a great job. Long-time listener, first-time caller. But you're a credit to the industry. Honestly, you're providing a wonderful service.
That's very kind, mate. That's very kind. So let's talk a little bit about QCP. So obviously you guys are huge in the space, right? I consider you guys like pioneers in the crypto options space, right? Darius has done an amazing job over there. So tell us a little bit about sort of your journey into crypto and kind of what your role is over there and how things are going.
Yeah, sure. Things are going great. So that's good. I got into crypto sort of in the early 90s. And that's obviously a lie, but I said that at a conference the other day and nobody laughed, which was disappointing. I never sort of saw moving out of TradFi or whichever kind of derogatory term we want to use, legacy finance, maybe, as moving at transitioning from one industry to another. To me, moving into crypto felt like the only way of staying relevant in the industry I was already in. And so, I think sooner or later, and maybe sooner than people realize, I'm going to stop treating these two worlds so separately. And I think crypto very quickly, and there's been many catalysts this year, will just become part of the capital market structure. And you're even seeing some of the regulators, some of the more innovative regulators, regulated that way. And so, as you said, yes, I currently serve as the CCO for QCP Group. Just give you some of my background. So like yourself, for my sins, I was in investment banking for the better part of about 15 years. Then became a partner at a macro hedge fund. And then earlier this year, I joined Deribit and Melvin Deng, our kind of incredible founder and our CEO at the mighty QCP. Before I explain what QCP does, though, and get into some of that, let me ask you a question. How many exchanges, CeFi plus DeFi in crypto, do you think there are? Make the market 10 exchanges wide.
Are we talking about spot or just options?
Any exchange that exists in crypto, CeFi plus DeFi, what's that total number?
Oh, that's
$1,000 a point.
You know what? Seeing as you said the number 1,000, I feel like saying that, but I think that's a bit high. I'm gonna go for like 350, something stupid like that.
That is stupid. It is multiples of that.
Multiples, really?
Like babies in India, 50 new exchanges are made every minute. It is ludicrous how many exchanges. No, that's obviously not true. Nobody knows the real total, but it's somewhere in the ballpark of 1,750. I've been told under good authority. A lot of them obviously are pretty dead, don't have liquidity. Many of them won't exist in the future. Mm-hmm. But why I make that point is
that is crazy.
It means because of that fragmentation of liquidity, it is nigh and impossible for investors to navigate all of those indices. So it's actually the asset class where the market maker is the most important participant. And that's one of the reasons why I joined QCP. Also, if you think about it holistically, the only price discovery we have when traditional asset classes are shut is a few hours a day and 2 days at the weekend in crypto. So in many respects, the only kind of sort of like real barometer of truth in risk pricing is in crypto for that period. Similarly, it's an asset class with the most amount of alpha and the sort of maximal tradable gamma time and the least amount of sophisticated capital. So we kind of solved for that by housing all of our legacy sophisticated trading strategies into a hedge fund a couple of years ago and sort of seeded that ourselves and are starting to raise external money for that. That's called Primrose Capital Management. I'm super excited by that. So that's led by our CIO, Linus Ong, who I would never say to his face, but is an absolute genius. And he's hired a world-class.
I'm sure he watches the show, so he's going to see that.
For sure. No, he's quite a discerning podcast listener. Kidding. He's fantastic, and he's hired basically all of his former colleagues from WorldQuant and Bluecrest, like the best quant funds on the planet. So super excited by the sell side of our business and the buy side of our business. The easiest way to think about it is kind of mini UBS on the sell side, mini Millennium on the buy side. So QCP sort of in summary is Asia's leading digital asset partner. We're headquartered in Singapore. That view behind me is the boat key. Servicing everyone's needs from sort of cash on-ramping right through to complex, structured, bespoke, exotic products. We've got about 120 people across multiple geographies now. We're expanding rapidly, and we've received sort of IPA licenses in both Singapore, Abu Dhabi now. I could not be happier working here. It is a preeminent derivatives firm, but actually there is really nothing we can't do for a client. We do the entire breadth of products in the space. So it's the perfect role for someone like me with very solutions-minded background.
You can tell you used to work in sales, by the way. I mean, I'm like, wow, QCP just sounds amazing.
And we're hiring, so you can send me your CV.
All right. Anyway, that's enough about QCP. What I really want to know is about the evolution of the crypto vol market, because you guys are very well placed. You've been like top 3 forever on in terms of volumes in options. So, you know, you're probably best placed to answer some of these questions that I've got as to kind of how the microstructure of the market is evolving. You know, is it following more of an FX path? Is it following more of an equity path in terms of what clients are doing? Things like that. What are your thoughts there?
Yeah, no, honestly, it's a fantastic question because it's one I think not everyone's fully understood. And a lot of the bias is because of who is in the industry. Actually, it is massively overpopulated with FX and rates people. And I'll tell you why I think there needs to be more equity people in the space. To me, it's a misnomer that it's called cryptocurrencies. There's the kind of the issue from the get-go. You know, as kind of Michael Saylor keeps saying, it's the wrong phrasing. It should be crypto capital or something like that. Whatever it may be, it shouldn't be cryptocurrencies, because besides stables and Bitcoin, nothing else remotely resembles money or coins. And we can call them protocols, projects, platforms, call them whatever we like, but they're all essentially corporates in some respect with varying degrees of governance, right? So, you know, staking yields are akin to dividends. Stock loan is just the credit part of the market. And so, you know, from my perspective, the industry just goes to big, passively tracked benchmark indices. And so I think the issue has been from the start is that whoever's head of PR and marketing in crypto should be fired. They just keep calling things the wrong things and overly complicating it. And the language is exclusive and it should be inclusive. And so the reality is we've seen this micro market structure before. We know where it's heading. It is the stock markets, right? And so there was this view that we couldn't possibly have credible benchmark indices because Bitcoin's dominance was just so high. And it's gone even higher, obviously, in sort of recent times, right? But you only have to look as far as Asian indices to appreciate how little investors have historically cared about that. Look at HSBC's weighting in Hong Kong. Look at Samsung's weighting in Korea. We've never cared about one name massively dominating a benchmark. And there are ways to reduce that anyway, naturally, right? And so from my perspective, all that's going to happen is we go to big benchmark indices, Bitcoin and Ethereum obviously being the bulk of that. But as we get more liquidity in some of the sort of more credible alts, that becomes a credible. We always congregate around one benchmark, right? It doesn't necessarily matter who's the best at the beginning. The winner in the end are the ones that have the most liquidity, right? And so whatever you think of MSCI's business model, they dominate a lot of indices, right? And so I think whether it's MSCI, some crypto equivalent like coin indices, we go to these benchmarks that are, let's call it 10 to 20 coins. They are passively tracked. There are quarterly rebalances of names. And, you know, what does that mean the trading strategies look like? It's just your classic index rebal trades. It's additions and deletes. What we're going to see at scale in the NASDAQ 100, now that people are unavoidably exposed to MicroStrategies because they have an buy of 47 dip weighting now. And so what is wonderful to see is people that have always hated this industry have to buy it because they don't now. They are mismatching benchmarks that they are telling their clients that they are tracking, right? And so I think that's what happens from a sort of spot index perspective. BlackRock wrapper in the ETF around every major one of those. You get every West Coast firm that doesn't really want to touch it eventually capitulating and having to. And then what does that mean as the derivative market evolves? It means as index optionality, which doesn't exist today because we don't have any kind of benchmarks people have congregated around. Once the volatility markets on that picks up, all your ARB funds trade volatility dispersion. They sell index vol by single component vol. And it just looks, and so like every this was my point about the equity versus FX and rates. A lot of the visionaries in crypto, absolutely FX and rates guys, because they understood the macro narrative. From my perspective, the people that will make money in the future are equity multi-strat desks because they've been doing this their entire lives.
Right. Interesting perspective. So something I've talked a lot about on the show is the gamma positioning, right? So we have Amber Data. I don't know if anyone else does it, but certainly Amber Data track the gamma positioning of dealers in the crypto space, right? Yep. And we can get a feel for whether dealers are long or short going into an expiry. Now, this is like a massive deal in S&P, in equities, right? Because the volumes are so big, arguably dealers end up with $10, $15 billion of gamma sometimes. And that's a really significant number, and it really prevents the S&P from going anywhere. So the S&P ends up getting pinned into expiry on a regular basis when you have the really big expiries. In fact, end of the month, December is a prime example. We've got a massive strike that the market is gravitating around. Now, I feel that we're nowhere near in the crypto options market where the gamma positioning is big enough to prevent the asset from kind of moving. I think that the underlying volumes and flows massively overwhelm any of the options and derivative hedging that goes on. So obviously that's my view, but you guys are much better placed to answer that question and confirm or disconfirm that. How do you feel about that? And are we heading to a place where it is going to matter? Are we months away from that? Are we years away from that? What do you think?
You're absolutely right. When I look at the breakdown of flows, it doesn't even matter if I tell you what that gamma position is. We don't need to really know today. It's good to know where the sticky strikes might be, but you can largely guess because it's actually, people trade options quite psychologically when there's a lot of retail participation. So your 100 strikes, your 90 strikes, it's always your round strikes, right? But why I say it doesn't really matter is because I fully agree with your point that the underlying spot market is still so many multiples of the derivative market that it's just not impacting. If we get a large individual whale trade on any given day, it's going to go that direction, irrespective of any gamma positioning. Mm-hmm. Because let's call it, I'm making this number up, but I want to say it's something like 2% of total spot volumes are in derivatives, which, as we both know, in any other asset class, and especially equities and commodities, the derivative market actually is larger than the underlying spot market. And so your question is, are we heading that way? Unavoidably, 100%, which is, why a firm like QCP, who've been at the forefront, done some of the first ever transactions in derivatives, done some of the largest ever trades in derivatives, done some of the most complex structure, are light years ahead of a lot of our competition and most investment banks. If an investment bank wanted to trade crypto today in options space and is not touching the native market, which we all know they're not really allowed to yet, right? Then effectively, they're playing a game in the dark without knowing all the rules. So we have such a structural competitive advantage over the people that have done this for years, just because we can access all of that liquidity. We have a lot of insight into the flows because it's not a normal market. When we think about like who participates in FX markets, in commodity markets, in equity markets, there's a lot of overlap, right? Often I've covered the same CIO, head of asset allocation, or like 6 asset classes, right? And so we know that's different in crypto. You have very different corporates, you have protocols, you have miners. And so it's that sort of knowledge and institutional history that, a lot of people don't really appreciate where the flow's coming from. But what happens going forward is, and I guess we can talk about this extensively later on, but like the ETF options market is just going to drive a lot of new liquidity in crypto options. So, there's a lot of people that still feel like it's going to take liquidity away from the native market. 100% incorrect statement. It is going to drive even more liquidity. Look what the ETFs in sort of equity land have done, right? Why are those flows so important? I mean, you're talking about gamma, but also the Vega. Like, if you think about all the things that have happened in equity markets that were not easily described in real time in the last sort of, let's call it 6 years, a lot of it's retail structured product flow. And that, if you do not know where those pins are, what the hedging activity is, you are pretty screwed if you're trading vol. And then obviously that bleeds into gamma because people have come shorter down the risk scale, especially in equity markets over the years. So so understanding what these data points look like today, get used to it, because those numbers are going to explode in size. And you're absolutely right. We're going to have sticky strikes. We're going to have strange behavior that can only be explained because of the option market's impact on delta. So it's definitely something we're looking at very, very closely.
The point you made about banks not being able to trade native crypto vol, essentially like Deribit, basically, right? So that I suspect that's the reason why like IBIT options trade at this big premium to Deribit, right? Because of the fact that there's no one able to arb that and compress that spread. Is that right? Or do you think over time that will compress?
Well, you also got to think about there's several crypto firms can't trade equity. That's also something that they have to transition to if they want to be part of the whole ecosystem too. So I think we've been focused on for quite a while because we knew it was going to be important.
An IBIT is considered an equity, right? Because ETF.
100%, right? Yeah. And so if you really want to be meaningful and all entirely on top of the market in crypto derivatives going forward, you have to understand everything that even remotely looks like crypto, which means you have to understand the CB pricing of MicroStrategies, which you have to understand how Coinbase being priced, how Galaxy's listing in America might look. Like you need to understand all of these things going forward because the crypto ecosystem is much larger than people realize and people are unavoidably exposed. We get heads of, sort of top of shop people at sovereigns coming into our office all day long and just being like, tell me everything I need to know about crypto. And they're all preparing because they know it's now unavoidable because the largest asset manager on the planet has legitimized them.
Yeah, it's really funny. This reminds me of a point that Dave Brickell makes, my co-host makes a lot, which is like, there used to be a stigma attached to crypto and there was career risk attached to getting involved in crypto. But now that is flipping on its head and there's career risk now. If you're not involved and you don't have a crypto strategy, what are you doing basically, right? So that is super interesting, that dynamic.
It's exactly the same argument that people made for years that were sort of West Coast pension funds. They'd go like, I go see them, year after year, and they'd be like, Andy, I'm never losing my job buying the S&P. I'm 100% losing my job buying Vietnam or China or any sort of illiquid equity market back then. Same argument, right? It's not that people are not interested and compelled into crypto. It's exactly what Dave says, what you've said multiple times, which is, it's not worse. There's asymmetry to the downside in this trade for my career.
So something that I remember QCP being super active in a few years back was the DOVs, famous DOVs, DeFi option vaults. And it was just basically packaged products of people call overwriting, put underwriting, basically yield enhancement strategies across the space, right? And that created this seasonality of vol over the course of the week, where you'd see implied vol get smashed on a Friday as all these sellers came in and did the fresh 1 week selling programs. Now, I would have thought after the DOVs went away that we wouldn't see that seasonality quite as dramatically. But when I look at the chart every week on crypto vol, guess what 1 week vol does every Friday? It gets smashed into the weekend, right? So is there still a lot of systematic flow around, just not wrapped up in DOVs doing the same thing? Or is it a case that people just don't think the weekends are going to move that much, so vol prices itself lower into the weekend?
So I've got some sympathy for the last thing you said, but I think it's more just a function of behavior. People were used, like you said, just so used to smashing those vaults and spending all that money in nightclubs at the weekend. And so now they've just got used to selling vol on a Friday. Like the point you made when we were speaking earlier today, I was saying that's equivalent to kind of systematic call overriding in equities, which used to be 1 month. And you're like telling me now, like the 1 days are so huge in volume that no one has any attention span. I mean, if we look at the bias of that flow, I know a lot of it comes out of Asia. Because Asia trades vol very differently to, let's say, North America. and this is not a racist comment, this is just pure observation over many, many years. Americans often treat option markets like cash markets. And they use that leverage to enter spaces, to hedge things. Asians at a very generic level are always seeking yield. And so that's why you get this sort of bias of overriding flow that just wants to take in some premium. And they've generally got a lot of assets on the other side of it.
Right. Okay, cool. I definitely see value in doing that, as in I do that trade as well, just to kind of lean on the fact that I know the flow is generally going to come that way. But I just wanted to know if there was like just big AUM and big volumes who were doing that systematically, right? Because also I feel like systematically, if I was running a systematic fund doing that, I would probably want to blend it. I wouldn't want to telegraph my timing so much, right? I want to kind of tranche it over the week or over the month in a way that it wasn't so obvious when I was going to come to sell, So I don't really know why they don't do it that way.
But, it's to the point, who's doing it, right? It is unsophisticated capital largely. And so as we get more institutional players, as we get more people with your background, with 100% of their focus on it, which I know yours isn't because you do every asset class. But when more people like you decide there is so much inefficiency in this options market, there's going to be so much liquidity going forward. I'm an idiot if I'm not trying to capture those basically alphas.
Yeah. Okay. Fair enough. All right. I've got another question. I've got lots of questions for you, to be honest. But we'll probably talk 3 hours. But
I've got 7 minutes for you. No.
So the thing I've noticed very, very clearly in crypto markets is there's a structural bid for long dated upside. Okay. So whilst the front end of the skew is being driven a lot by spot direction. So when we're ripping higher, there's a call skew in the front. When we're selling off, everyone panics and buys short dated puts, and we've got a put skew in the front. But the back end skew goes nowhere. The back end skew is just priced for calls all the time, right? And to me, as a long-term bull who's allocated a reasonable amount of his capital into Bitcoin, it just looks ridiculously attractive for me to use that long-term skew to layer a risk reversal around the top where I sell, say I own Bitcoin at 100K right now. I can sell a call at 200K and I can use that premium out to say next September. And I can use that premium to buy an 80K put, which is 20% out of the money, and sit on that knowing that I'm protected for more than 20% drawdown and I've got 100% upside still on my holdings. And I spent no money for that. How is that not the biggest no-brainer for every institution that ever invests in crypto? Please explain.
So I guess the first point I'd make is if you were doing that OTC directly with QCP, you could buy the 85 put. So think about that.
This that salesman again coming out.
You've got my number, so we can onboard you. Look, I think it is a no-brainer. Like, it's not a hard question to answer. 1,000 different reasons that makes a ton of sense, right? And like, unless you're a Bitcoin maximalist like Michael Saylor and feel like emotionally uncomfortable about capping any upside, why would you not do that trade all day long? 100%, Imran. I agree with you. But like, let me ask you another question: is what is the fair value of Skew long term in crypto anyway? Because we can say it looks this way because of the disproportionate participation from individuals and family offices and whales. But what do you think it looks like in 2-3 years? Because I'm just telling you, I think it looks like an equity market structure. Everyone else thinks it's like a macro market or a commodity market, which has a positive skew. Equities obviously have negative skew, and there's lots of reasons why that exists, some structural, some fundamental. What do you think?
Well, I also think you've got to factor in that the funding's at 15% a year, right?
Sure.
So when you're putting that hedge on, you're also benefiting from this monster funding rate that you've got when risk-free rates in like the dollar are like 4%, and I'm seeing the forward in Bitcoin at like 15%, and I'm selling that forward when I do a risk reversal, right? So I'm just getting all these benefits of putting this hedge in place. I mean, look, I would think, as we spoke about this before, right? I almost I almost think the long-term skew is a barometer of how much institutional capital is in the space, right? The more institutional AUM that comes into the space, the more people who think like what I'm saying and saying, well, why would I not do this? I've got 100% upside for a year and no other asset's going to give me 100% upside for a year. And yet I can protect the drawdown. I'm a moron if I don't do that, right? Now, obviously, you might not want to do that with your PA money because you're in crypto for the 100x, for the 10x, whatever it is, right? You think Bitcoin goes to $1 million, you don't want to cap your upside. But when you're running other people's money as an institution and you're allocating to crypto to diversify, there's no other asset that's going to give you 100% return in a year. You should be quite satisfied with that, right? So that's my feeling on it.
I think you're absolutely right, Imran. It's an absolute no-brainer trade, and I like that notion of it being a barometer of institutional participation. And I'd also say, especially the left side tail, the lower that goes, you basically, it's also a barometer of how sophisticated the product land has got, how many structured products are being issued, because that obviously flattens downside vol as well.
Well, that's a perfect segue because you guys are all over the structured product space, right? Offering all these random payoffs and stuff. So tell us a little bit about random. Yeah, I call it random. They're not random. You can elaborate on that. So what type of structured products are you seeing their demand for? And, what is the advantage to people for, looking at these structured products, right? Well, what kind of you're the sales guy. Give us a sales pitch. Like, what are the typical structures that are just super attractive in the structured product space in crypto?
I feel like you keep saying you're a sales guy, not a very complimentary way, but I'll let it go.
Well, I was a trader for 20 years, so I've got a love-hate relationship with sales.
Well, I was a trader for 10. Come on. I think, let me take you through kind of the ETF thesis, and then I can get onto some of the things we're doing with clients. Because I think it's important that people have more context on why we think options and structured products are going to grow so much, because it's really not being driven by the native market. It's really the ETF thesis that I think really capitalizes that. I can get into what we have been doing, and there's a lot of interesting stuff we're doing, but it's nowhere near the scale of what I think is coming. So obviously, I know we're short on time, so I would love to waste a little bit more of it and tell you a story about my childhood. So when I was about 5 or 6 years old, I found a bottle of my father's whiskey. It was Macallan 12 in the kitchen cabinet. I proceeded to drink it because I grew up in Newcastle, obviously. And my parents caught me, and they made me drink the entire bottle as punishment because they wanted to teach me a lesson. They wanted to teach me a lesson about brand loyalty. And I drink Macallan to this day. I thought it would have got a bigger laugh from you, but I'll also let that go. The point is, institutional investors have enormous brand loyalty to BlackRock. And so when a firm that has more AUM and index and ETF products decides, like we said, to legitimize the Bitcoin industry by turning it into a cash ETF, everybody needs to take note. Like, I don't know if people that are not in the institutional world understand how big BlackRock are. The level of AUM they have is like more than UK plus Japan GDP on any given year. Like, it is staggering numbers. What does that mean? It means they have an enormous distribution network. So why I'm so excited about everything that's going on in sort of Bitcoin ETFs is because for the first time in crypto's entire history, education at scale is taking place, because every BlackRock banker, every financial advisor at BlackRock is knocking on the door of literally everyone they know and say, add this into your portfolio.
Yeah.
And when they say, I don't know anything about Bitcoin, they get experts in to teach them about Bitcoin. So education always been, an issue for adoption, right? It is just very complicated, crypto. It took me a long time to get my head around the academic side of it. And this was always my big thesis, was that it was always going to be ETFs, not tokenization, that was going to catalyze large-scale adoption. And the way I like to think about ETFs is I think about them as the exact inverse of tokenization, bringing native assets to real-world investors. And that was always going to be the meaningfully more powerful driver, right? So why was this launch so monumental? Let's just think about it, the sheer scale of it, right? To the sort of the beauty of a US listing guarantees a fully functioning options market, and then we can talk about what that means for structured products. 3, like I said, this sort of educational side to it is so important. And I bet BlackRock's obviously BTC ETF, I mean, single biggest launch in history, Imran. This is a 40-year-old industry, right? This is not crypto. This is 40-year-old conventional assets industry. And let's just take a moment to hold for applause. Well held. $50 billion in assets, right? Total assets. 2.5% of BTC supply, all right? It's more than Saylor has. And it's more assets than gold ETFs now, BlackRock's gold ETFs. And that's a 20-year-old industry. I was one of the first market makers in some of those gold ETFs. When you would have liked me and I was no longer, when I was a trader. And so, it's just staggering, the enormity of what's going on. And let's talk about the derivatives market now. First day of trading, $1.9 billion of notional. Very first day. Another record. It's traded north of 2 yards on multiple days in the last couple of weeks since its launch. We have no visibility. We have some, but most people have zero visibility on what might be trading OTC. So let's just call it that number is bigger than even that. It is my personal belief that this catalyzes $1 trillion market in retail structured products. And why I think that is because now we're in a listed equity underlying, right? If anybody needs any context, I actually wrote a white paper about the evolution of retail structured products out of Asia, then North America, a few years ago in a former life, which, I'm happy to send to any of your subscribers. And it just sort of takes you through why this industry became so massive. Because most retail structured products are merely bond substitution. Investors, retail investors in particular, trade them just because risk-free rate is low. I need a yield. One of the ways I can get that is through these kind of equity structures. There is no operational uplift for any private banker to sell structured products on IBIT now, anywhere in the world. No hedge fund manager can be told by their head of compliance they can't trade crypto options anymore because they're listed equity. We've endorsed so much nonsense in ETF lands over the years. Crypto looks very credible up against a lot of these things that have been turned into passive trackers, right? And so that market just grows and grows and grows, and we want to be a very meaningful part of that. Get back to what we sort of do today. We, before any of these launches, obviously IBIT options have only been trading a couple of weeks, right? So this is what I'm saying I predict is going to happen. We've still got, a way to go till that builds out, till that ecosystem grows. But it 100% will happen. There's no doubt in my mind that structured product market, especially out of Asia. So back to your earlier question of what does long-term Skew look like, it will be dramatically impacted by that, but not in the same way or the extent that it would be in an equity market. Because the reason why it's so impactful in an equity market is because banks don't really have any discretion to house that risk anymore. QCP have discretion to house that risk. A bank that is submitted to Volcker's rule has to give best efforts to hedge that in real time, which is why knowing what that flow looks like, knowing where the strikes are, makes it so easy to be on the other side of it as a hedge fund because they formulaically have to hedge out of that. VAR post-crisis across the major investment banks was down 75%. So it's that necessity for banks to passively hedge a lot of this, which creates enormous distortions in spot markets, in option markets. And when we get to where we are in that world, and like we discussed earlier, we're nowhere near that yet. But when we get there, having that data set, understanding why that flow comes and where it goes is going to be so important. So look, back to what we do with sort of native clients today, right? Like, I mean, if you're a miner, a family office, a sovereign, or a MicroStrategy equivalent, and you're not talking to QCP, here's the sales guy again, you need to start questioning your poor life choices. Like, there's so much we can do for clients. You just reach out to me directly at andrew@qcp.capital. I'll let you know how we can help. But like, let me give you a couple of examples, Imran, right? We're providing sort of bespoke solutions to many, like a new generation of investors, right? It's public information. I don't know if you're aware that we were advising Metaplanet, listed Japanese corporate, phenomenal performance this year on the listed on the stock exchange. It is the MicroStrategies of Japan. And why I'm comfortable talking about this is because it's already in the press, and we've given obviously quotes on this. What we did for them was essentially execute a synthetic mining operation. And so we just sold a bunch of short-dated puts for them, obviously based on a certain strategy and technique. MicroStrategies raises debt and issues CBs to fund their Bitcoin purchases. These guys geniusly used how high the vol surface is to basically take ownership of Bitcoin. And so both great strategies in reality, just different ways of doing it. And so, everyone's so focused on sovereign strategic reserves now, given everything we assume President Trump is going to do. And that's huge. Obviously, that's mega. And even if like 1 bip of allocation into a meaningful sovereign went into Bitcoin, it's going to be at your 200,000 strike pretty quickly.
You mean El Salvador's not meaningful?
Come on, let's not have this conversation. Let's say G10. And I don't make the decisions in the G10, so it's not that they're not in it because of me. I would say these types of country are actually the most interesting partners for us. So sovereigns of countries of that ilk who are being so progressive, are getting access to dollar markets for the first time in their country's histories when they've never had stable money, right? Some of these people are trying to do Bitcoin bonds. They're trying to raise debt in that. We've seen what Michael Saylor's done. It's actually unbelievable what he's done. If somebody had said that to anybody I was wearing a tie at a bank 5 years ago, they would say, I'll bet you $1 million that never happens. Like that 5 years ago was so far away from where we are. Now Saylor's the most credible guy in the room. And so it's kind of unbelievable what's going on.
Push back on this.
I'm sorry, Imran, I think we're out of time.
People want to hear your... People who have got this far down the podcast will want to know your opinion on this, right? So, and I want to know your opinion on this. So, what he's done right now looks like freaking genius, right? He has effectively arbitraged the financial system. That's what it looks like. He's realized that you can raise money for next to nothing on fiat, and you can park it into Bitcoin. And in a world where central banks have been printing, and there's no way out, and we've crossed the Rubicon, that is just a winning trade long term. The more you zoom out, the more tantalizing that trade is, basically. Okay, so I get that, and I don't disagree with the thesis, right? However, what I have got a problem with is the risk management side of this whole equation. Okay, and the reason
I've got a problem with them personally.
No, I've never met the guy. I would love to get him on the show, but I don't think we're quite big enough to entice him just yet. But the point is, what I have a problem with is the risk management. And the reason I say that is because, yes, we zoom out enough, we can see Bitcoin's gone up in like an exponential curve. But when you zoom in a little bit, it has periods of 12 to 18 months where it gets shat on and it drops by 80%. Okay? Excuse my French. Okay? Now, there will be a period in the not too distant future when Bitcoin decides to have a 50% drawdown. Okay? And I question this strategy. The amount of wealth destruction you will see when that 50% drawdown comes is just nuts. And the kind of products that are being launched, like the 2 times leverage ETFs on MicroStrategy, and they've got billions under management and stuff, they're going to go to zero one day when it drops 50%, if it drops 50%. And that's not inconceivable. If Bitcoin has a down 30% day, MicroStrategy has a down 50% day, and the 2x levered ETF has a see you later, I've gone to zero day, right? That is going to create reverberations across the space. And I feel that with a little bit of freaking risk management, that could be avoided. And he's not doing that. So that is my pushback. I don't think that makes him the most credible man in the room, as quoted by you. All right, over to you. What is it? We're going to have to wrap this up soon, but I'd love to hear your opinion on this.
We're going to edit that out, right? When I said that.
No, we're not.
So sorry. So your issue with him is that he's not doing your trade at 200 calls financed by puts.
Well, he doesn't have to do that trade, but the point, he's making so much freaking money and he's spending none of it on protecting the disaster scenario, the risk of ruin. You know the term risk of ruin? Good traders protect the risk of ruin. I don't think he is.
Yeah, I fully appreciate. I know. So let me just say, I'm really glad you used the technical term "shat on." But I think you're 100% right. The risk management of this is ludicrous. The one thing
non-existent.
The guy, yeah, that too. The guy has giant sized cojones, clearly, but he could do very simple things. Now that he's so far in the money,
yes,
he has so much credibility at the largest tables in finance. If I were him, I would 100% change tact. But if I was him, I would never have done what he's done. So he's got himself into this position, but then I agree with you, is he could do some very basic strategies, some realignment of that. It doesn't mean he's not mega bullish. You're absolutely right. There's so many people in this trade now. If he wants to fiduciary look after them, there's stuff to do, I guess. I don't think he does. I'm in no position to advise this man how to run his firm, but
I'm happy to advise him. He should give me a call.
There you go. And I heard you quite cheap these days, right? We're all Imran, we've all never been more talented and paid less in our lives. That's fine, but we're in a very fun industry, and that's good for the soul. I think Saylor absolutely could do things that could sort of future-proof a lot of this genius strategy so far. And you're right. It's not, if get a 50% drawdown, he's wiping out an awful lot of wealth.
Massive, right? Massive.
And he might be the only guy that's okay to sit it out, because we know it's going to rally back, right? And so,
yeah, that's right. We do know that. So the question is, why would you not protect your risk of ruin so you can stay in the game, right?
The scale of it, though, has grown so large very recently, that it will impact the entire ecosystem, because if there's a mass exodus out of that trade, right, we know people are doing the CB trade, right? We know people have got massive deltas in his stock now that are trading this. If there's a massive unwind, then you don't just fall down 50%, you massively overshoot. And then it's can he pay any of the, I don't know what the bond covenants look like, to be honest. Haven't looked at any of the papers in any depth, but does he breach some of those? Is he able to pay the interest payments? Never mind, can he eventually pay the bond back? Again, not for me to judge him, not for me to give any advice in reality, but you're absolutely right that there's no risk management of this going on. It's a proper's believers trade. They're not vol guys. They're very different view of the world, right? We are part of this very sort of esoteric part of the market. What I would say in their defense is, are they just too big? I don't think they can actually do anywhere near the size they need to do of the things you just said, because
they'll just call up QCP and get a bit of OTC pricing, no?
Yeah, I mean, I'll make them a choice price, but the basically there's no long dated market in this stuff, right? And that's why you can't hedge a 30-year convert with any long dated vol, which is what actual normal CB is actually monetizing that inefficiency of the low vol priced into the CB versus the high vol of the underlying asset, right? That's traditional classic CB which cannot be done really in MicroStrategies, right? So we can say like maybe they should think about the risk management at this side, but I just think they're too big. I think,
Yeah, but that statement scares me. When someone gets too big that they can't risk manage, that means the downside is that much bigger when it finally comes, right? It might not come for another year, but when it comes, it's going to create some serious shockwaves.
Well, look, who knows? And I don't know if you know those firms, but these are exactly the kind of conversations you should be having with them. You can absolutely help those types of firms. And we do this sort of day in, day out, because people are just not necessarily aware of the things you can do in optionality.
Yeah, and the beauty is the liquidity is good. The liquidity, Deribit's liquidity is amazing, right? And so even if I'm running like $1 billion fund, there's a lot you can do, right? Maybe you can't do it in one shot, but you can get into some decent size. I mean, we saw it, like you will have market impacts. I mean, we saw big call overwriting in Ethereum, which as you must have seen a lot of that flow, the call overwriting on Ethereum that took Ethereum vols trading below Bitcoin vols last year or whenever it was. I mean, actually on that point, I mean, that's all dried up and disappeared now by the looks of it. Is that right?
Well, I mean, when spot's moving so much, you don't like systematic overriders and the like obviously step back.
Yeah,
because it's not even that they're getting killed, it's that they don't see the need to so urgently sell the others because they're performing. Their performances are performing so much. But look, I mean, the one thing I would say, even where you can do meaningful size in crypto, let's be clear, there's still a massive duration mismatch. We cannot do long dated vol or at scale in crypto today because there just isn't any fair value of that vol. Because just like we don't know what fair value of Smile long dated is, we actually don't know what that absolute vol number is, right? Like we've already come so far. We were 10x S&P as little as 7-8 years ago in terms of absolute magnitude of vol. That's got down to maybe like 2.5, 3 at the lows now. Where does that settle longer term? Does it just look like NASDAQ vol? Maybe. I don't know. But we don't know, Scoobies, where that long-dated vol is going to settle.
Yeah, but I'll be honest, those hedging structures that I'm talking about, I don't want to do them in 5-year maturity, right? Because actually you get more bang for your buck doing them in like the 6 to 12 month bucket, right? Because if you think about it, what happens when vol spikes? It's the front end that goes nuts, not the 5-year vol, right? So actually for those crash protection trades, your optimal duration is probably 6 months. And then when it becomes 3 months, you roll it and you keep systematically doing that. And I think there's tons of liquidity for that sort of thing. Yeah.
No, that is absolutely fair. If you're just protecting, a massive directional short-term move, then for sure there's scale you can do. So that's fair.
Andy, we're going to have to call it a day because I think we've overrun by almost twice the time. But this conversation was epic. I mean, you are a wealth of knowledge, obviously. And you're quite a funny bloke as well, to be fair. I have to say.
Thank you. Quite funny yourself, Imran. All right. Thanks, mate.
All right, mate. Well, keep in touch. It's been a pleasure getting to know you, and I would love to have a conversation again. I'm pretty sure the viewers are going to like this one. This one was full of golden nuggets. So thanks a lot for coming on the show, man, and I'll catch you next time.
Thank you. Cheers.
Yes, that was good, right?
Yeah, very good. Yeah, good conversation.
We need to get him in the studio if he's ever in London.
Yeah. That would be a good chat, actually.
Yeah.
I think it's a little bit unfair that you kept hammering him for being like a sales guy.
I know. I didn't mean to, but
but he's good. Like he speaks
You're a sales guy as well, so you would stick up for him.
But yeah, he articulates things very well around some of the themes that we've discussed. Certainly, it's interesting the way he sees the market evolving, and it's what we've said, right? It's going very much. I thought the like the comparison like with equity was a really good one.
Yeah,
and thinking about that because a lot of people do think of this as being a FX like market.
It's called cryptocurrency.
Yeah. And actually, I think he's thinking about it in the right ways in terms of actually. Particularly with a lot of the other tokens, when you start moving away from crypto, that they are more equity-like.
Like small cap equities, basically.
Yeah. And eventually everyone's going to come around to just seeing it like that and trading these things that way. So yeah, I mean, like great vision from them and what they're building and what they're doing.
Interesting chat about MicroStrategy as well.
Yeah. I mean, I like intuitively, it's one of those like when you look at MicroStrategy and you go, this blows up somewhere. I don't. what happens when we have that drawdown, and I guess that's your point.
Yeah, it's very hard to predict when you get a drawdown. It's just that it's that point I made about if you zoom in and zoom out. When you zoom out on Bitcoin, yes, it goes up every year, 50% on average, and it's probably going to go to 1 million one day. That's not a hard view to have, right? But when you zoom in, you get periods of 12 to 18 months where it really gets hit quite hard. Given the structure given the way the market is kind of shaping up, what happens in that period? Like to MicroStrategy, to all those ETFs, what are the consequences? Does it lead to these ridiculous liquidations? We just don't know. And I just feel like that is somewhat being ignored right now.
Yeah, and like it does make sense, like what you're saying, the fact that you can have this risk reversal on where you're protected for a 20% drawdown and you
still have 100% upside. Yeah.
And, that you can roll and probably, restructure those things as and when they come around. And we were discussing earlier, right? Even if you did it on half of the
half of the holding,
holding, it might make a lot of sense.
I think the issue that I have is when it becomes a religion, right?
Yeah.
And when people just like simple risk management, risk of ruin, those sort of things, I just feel like we can do that with our own money.
Yeah.
When we do it with our PA money, of course we can do that. And it's and we, if our Bitcoin all goes to zero, are we going to be on the street? We're not going to size it in a way where we're going to be on the street, right? And we can be a bit more reckless with it, I guess, right? That's what a lot of people are, quite reckless with it, right? But when you're running other people's money and you have shareholders that are buying your stock to get exposure, then it becomes a very different game, right?
Yeah.
And that's why I feel like just ignoring the risk management and saying, well, it goes up forever, so I don't give a shit. I feel that's a bit
not to scare everyone, but it does. There's shades to me of like long-term capital management, and when it kind of felt like they'd like
clocked it.
They've basically they've sold finance. Like then they've got a trade on they can't lose.
Finance.
They've sold finance. They've won. Right.
They've won the game.
They've won the game.
It looks like he's won the game.
Yeah.
He's played the game amazingly.
Yeah.
Don't get me wrong, but has he won the game forever? I don't know.
But like, I guess the flip side is, I like the comments he made yesterday when basically like this is kind of just this Ponzi that you're fueling, and he compared it to like in the property world and building Manhattan, and basically leverage has been built on the fact that the value of the underlying keeps going up, and then they get more debt to build more buildings, and and you're in that cycle, and so
look what happened in the housing market in 2008, right? So he's kind of proving our point.
Yeah.
He's saying yes, it's gonna work for ages, but then one day it's gonna be
and it's a short term pain, right? Because he's probably right over time. Yeah, and it's just how does that play out? And where I think he's probably going to be, he might be all right, is that he was just early and first. It might be when others start coming in to replicate that.
I'm really curious to know how many corporates are going to come and do similar things.
Like if you come in and you start building that strategy just before we get the drawdown, then all of a sudden you're underwater pretty quick. Although at the same time, the same amount of leverage hasn't been built up at that stage. But I think it's probably something worthwhile.
It's an interesting time to be in finance. To see this happening, to see this new type of financial engineering happening, right?
Yeah. And also now, like obviously the inclusion into NASDAQ 100, which again feels like a bit of a milestone, like for Bitcoin. Now everyone's having some pseudo Bitcoin exposure,
whether they want it or not.
Yeah,
that's right.
So it's huge, and God. We sat down a year ago, or just under a year ago, when we started doing this. I was bullish then, and some of the developments since then, like, have just played out better than I could have thought.
Yeah, I hear you. Yeah,
from like the Trump administration going in and all these picks that are all pro Bitcoin, pro crypto. Obviously, the ETFs, the success of the ETFs has just kind of blown all expectation away.
Ethereum ETF started getting some real money coming into it now. Yeah, right.
I mean, it is like, and you discussed in the interview there, like it is just, these are like 40-year markets that crypto's come into, and it's blowing away the performance of anything that's gone on. There's more assets now in the Bitcoin ETFs than there is in gold.
That's insane.
Like, that's insane.
That is insane.
So again, for me, like when I talk about and my bullishness, you talk targets, like of course Bitcoin's going to flip gold. Like, of course it's going to flip gold's market cap. Now, whether that comes in a year, 2 years, I saw Mike Novogratz saying like 5 to 8 years. I'm like, I think that's really conservative. Like, cause just look what's going on in that ETF space. Like, more and more capital is probably getting sucked out of that coming into this.
What are the numbers on gold? Like, what's the total market cap on gold?
So
right now?
I think I think
14 trillion?
Yeah, it's around 14 trillion.
And what's Bitcoin right now?
So around 2 trillion ish.
It needs the 7x versus gold.
Yeah. So like 7-8x. So 700-800k Bitcoin is with flipping gold.
Right.
Like, it does,
if gold's unchanged.
If gold's unchanged. Yeah.
Which it probably wouldn't be at 700-800k Bitcoin. I'm going to hazard a guess.
Yeah.
Gold's probably doubled from here if that's happened.
Quite possibly. Yeah.
So it needs to do a bit more.
Yeah. But
buy a million Bitcoin. But
then like, will gold double if Bitcoin does become the real substitution?
Yeah, it's a good question.
So maybe, I mean...
So no, Deribit have listed gold options now as well. So you can play that spread.
Yeah. And it's funny, I keep getting into arguments on Twitter and that with gold bugs. And I'm like, look, I hear you. I used to be one. Like, I'm like, your rationale for being long gold is spot on. Like, it's 100%. It's just that...
You're just in the slow horse, not the fast horse.
Yeah. I just think Bitcoin's a better asset. So it's going to be interesting. I think... yes, like it feels like the dam is broken, and like I don't know. I think there's so much money to come into this space that I think we can throw out some of the rule books probably over the next sort of year or two.
I actually think whilst I am bullish, and I will be bullish for probably most of next year, I think being in crypto vol is the place to be, really. Because I think it's shown us.
Surprises me you say that.
Yeah, it is surprising, isn't it? But I mean, just like you're talking about an asset that does 100% a year, right?
Yeah.
And it's done it 2 years on the trot. And it's like, we're about to go into another one, and it could go, it's conceivable that we see 250k next year. It's also conceivable that we see a 50% drop with all the shenanigans that's been going on with MicroStrategy, right? I just think, how can you not be in the vol space in crypto when that's your opportunity set?
Yeah.
You know?
Yeah. And I think like next year theme, I'm pretty sure starts to come, like all the big banks start coming in this. Like, I can't imagine running like a FIC desk right now. I mean, like, you got margin compression and all that sort of stuff. How you're not going, do you know what? The future of our business depends on us being in this 80-fold asset class.
Well, Andy, we were talking about it with Andy in the interview, right? How your point about career risk first was being in crypto has flipped to now not being in crypto. That's so damn monumental. And most people haven't even realized that yet, right?
Yeah.
It's crazy.
So a lot of exciting things to look forward to. And you know, the other thing with crypto, which I love, and I know you appreciate these days, like there's just so much going on, and we're innovating and evolving at such a rapid pace that who knows what lies ahead in 2025. It's probably things we're not even thinking about.
Yeah, it's the secular growth area, and coming out of banking that has been in secular decline for how long, right? It was just so refreshing to be in that space.
Yeah,
People want to collaborate, people want to build, and now that they're getting, the regulators are actually on their side now, that's only going to increase, I reckon, right? So
that's
a cheery note to leave you guys with for the end of the year, our special Christmas episode. I hope you enjoyed it, and we will see you all in the new year. See you next time.